It's time to check your money with your friendly neighborhood advisor. Mike Jennings is a wealth advisor, Brackens Financial Solutions Network, LLC, and a registered representative of LPL Financial, member SIPC. Mike, what are we talking about this week?
Well, first of all, I got another announcement, George. I
Oh,
forgot to
another announcement.
mention
Wait a minute. Hold on.
I
Hold on.
I,
Yeah.
I forgot to mention my birthday last week.
Oh my gosh. Happy birthday.
Thank you,
How'd you
thank
forget
you.
your birthday? How did we
I
forget your birthday?
listen, after you hit a certain, I don't have to tell you this. After you hit a certain age, it's like, it's another year. It's my birthday again. I don't really think about it, but
Well,
I'm glad
okay.
to
Is
be
it a
I'm glad to
milestone?
be appreciated. Oh no, last year was a milestone. I
So that's
turned
why you didn't
30.
remember. We always remember
Exactly.
that. We always remember the milestone.
Exactly.
All right.
30 is like 30
What
is
is
like woohoo.
what is the
31.
actual day of your birthday?
July 9th. July
July.
9th.
All right, July 9th. Well, happy birthday. If I had
Thank
Stevie Wonder ready, we would do it. Right. Wait, I might
you.
have 50 Cent over here. Wait a minute. Wait a minute, Mike. Here we go.
Uh-oh.
Go, 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 Shorty.
Yeah,
It's
make
your
sure you turn that
birthday.
off at the right
Yeah,
moment.
I stopped it right there. I knew where to stop it. Or else the
Good stuff.
Vicki and the whole crew be coming after
Yeah,
me.
that's right. That's right. Good stuff.
Because that's all we can do with that. That's all we can do.
hmm
But we gave
Pretty
you a little
much.
something that you can remember.
Yeah, that's right. That's right.
Oh man, well I'm glad. I hope you had a great birthday and
hmm
many more.
Absolutely. Thank you.
All right, so what you got for me this week?
So last week we were talking about debt, and, during our debt relief talk, I had made mention at the end about using a home equity line of credit or a HELOC to consolidate debt.
Mm-hmm.
Um, and the idea of home equity it's been a pretty consistent topic with people I've spoken with recently. So I figured, we could cover it. I'm sure we're both aware of the housing market in our area in central New York, which means there's a lot of people out there with a lot of home equity. So I figured we might as well talk about it. How's that sound?
Sounds like a plan. Let's go.
All right, all right. So let's get into it. So of course we all understand the concept of buying a home and having a mortgage and everything, right? But what many people are unaware about when it comes to home ownership, it's the idea of equity. So we'll use the general concept of like a balance sheet to explain what I'm really talking about. On one side of a balance sheet, you have your assets or things that you own of value. And then on the other side, you have your liabilities. So these are things that you owe or that you regularly pay for, your obligations. Now, when you buy a home, the home itself is an asset and it has value. And then, of course, if you bought that home and you use a mortgage to purchase it, that means that a lender gave you money to purchase the home from the seller, and you are now liable and paying it back to the lender, right? So you have the asset as the home, and then you have the mortgage payment as the liability. Now, the difference in the value of the home and the balance of the mortgage is called the equity that's in the home. So for example, you buy a home and you mortgage your home for $200,000. After a while, you pay the mortgage down to 150,000. So now you have 50,000 of equity in your home. Now, in this example, the value of the home stayed the same, but we all know that real estate is a market, so there is a variation in the perceived value of your home. That means the equity is dependent on how much is owed on the equity, is how much is owed on the mortgage, but then also the appraised value of the home itself. Now, if you have been paying your mortgage for many years and you live in an area where the housing market is thriving, you could be looking at some pretty substantial equity in your house.
I appreciate that explanation. You broke it down for us. Now, how do we actually get to use this equity?
So that's the question of the day. So many lenders, banks, for example, people that offer mortgages, they also offer products that utilize equity for use. Now, these are known as home equity lines of credit, and then also there are home equity loans as well. There are some major differences in how they work, but the idea is pretty much the same, and that's using the equity built up in a home to your advantage as the homeowner. Now, let's start with home equity loans. Now, home equity loans are loans that have a fixed rate and a term length used to access the equity of the home. This is pretty much like an installment loan. They're also known as second mortgages because it's kind of what they are, since the home itself is still the underlying collateral. Um, these loans, they provide lump sums to the homeowner upfront, and it's borrowing against the equity of the house to use the funds as they see fit. Now, on the other hand, you have home equity line of credit. And this functions more like revolving credit. So similar to like a credit card, right? Again, using the home's equity as the basis of what can be borrowed. Now, this allows the homeowner to have access to a certain amount of the home's equity without having taking a lump sum from it initially, like with the loan. You sort of just have this open account of credit that you can utilize for a certain amount of time. Now, unlike home equity loans, HELOCs, home equity lines of credit, will usually have a variable rate. So it's not fixed. It's a variable rate that can change over time, and that changes the amount of interest that's owed. Now, HELOCs generally have some pretty enticing features, such as paying interest only for that initial draw period, and only on the credit that you use instead of that lump sum payment. HELOCs will have, like I just mentioned, that initial draw period. So it's typically, depending on the lender, like somewhere between 5 and 10 years. This is the actual period that you can borrow from the line of credit. Then after that, it will be in a repayment period. So that's where you'll have to begin making not only the interest payments that you were probably only paying during the draw period, but also the principal payments on the balance itself.
Right, and it is a mortgage. Don't get it twisted. It is
Yeah,
a mortgage
absolutely.
against your home, a second mortgage
hmm
against your home. And so,
hmm
Mike, even still, these sound like great ways to use the value in your home. What would you say is the best way to use it?
It depending on your situation. So there isn't a requirement on how you can use it, but there are some advantages related to certain uses. So if you use this, either one, whether it's a home equity line of credit or a home equity loan to fund home repairs, renovations, or major improvements, then the interest that you pay can be tax deductible during that year, as far as your income tax. So this makes home equity products a great way to sort of, fix up your home or expand your home or sort of do anything, some of the things that you probably wanted to do. You just didn't have the cash before. Now you're using the equity in the home to pay to fix up the home, right? So it's a good deal. As I mentioned last week, many people use home equity loans or home equity line of credit to consolidate other debts. The rate you use, or the rate that your loan is going to have or your HELOC is going to have is subjected to, it's usually a lot less than something like that of a credit card, right? Home equity line of credit, I think for our area is probably like somewhere in the 7.5% range.
Mm.
If you're looking at a credit card, the interest that you're paying on that, depending on, where you got it from, it could be somewhere from low 20s to high 30s or high 30s, low 20s. Same thing what I said, but you get what I'm saying. They get pretty exorbitant as far as the interest fees. Um, Now, if you use a HELOC or a home equity loan to consolidate, you can pay less in interest than you would be if you were using a credit card. And then also, obviously, you're lowering your credit card balances. So both things are good as far as getting your credit score up. And the same goes for other debts like student loans, which also, has similar as far as interest rates to other loans, personal loans, but are probably usually a little bit more when it comes to the balance. So some people use HELOCs for larger purchases or expenses, like buying a new car or even buying a new home or an investment property. I know some people that use HELOCs or have a HELOC available, in case they're looking to purchase a new home or sell their old home, so that they can have that down payment ready, to go when it comes time to doing that. How you use it really is up to you, but of course, obviously, I'm a financial planner. Should be some planning involved in how you use it.
All right. So, speaking of planning, we're hearing all the good things. What are some potential drawbacks?
Well, as we just very, very much clarified, this is a mortgage. So, again, the collateral of these types of tools are the equity in the home and really the home itself. So, what that means is if you fail to keep up with these payments, your home could have a lien put against it, and it could even be seized and foreclosed on, like with any other foreclosure. So, if you spent decades paying down your mortgage, the idea of placing more debt onto your home and the possibility of it not going your way, can be a risk if you're not that you're not willing to take, and that's completely fair. On the other hand, some things to consider. You know, as an individual, you generally know how good you are with paying back things on time. I would say if you went through the whole process of having a mortgage and you built up some pretty good equity and you pay down that mortgage, you're probably pretty good at handling debt. So for you, this might just be another payment to plan for. Some other things to consider would be your age, your tolerance for risk and debt overall, your credit score, which will affect the rates that you are offered for these products, and also if these products are available to you, right? You should also be aware of the housing market that you're in, right? If there's a possibility of the value of your property, of your home going down, that can seriously impact the equity in your home and the loan or the line of credit that you acquired. So these are things that you definitely want to consider. Like I said, of course, your ability to be approved for either is dependent on your credit as well. So this affects the amount that you can borrow. Most lenders have a set cap or percentage of equity that you can borrow, that can be borrowed against. So some will say, you can only borrow 85% or 90% of the equity that's in the house, right? And also they have a minimum level of equity needed before you can actually use these products. So some might say you need 15,000 of equity available, 20,000, something like that, before you can actually get a home equity loan or a home equity line of credit. Now, if you're a new homeowner, it could be a while before you reach that appropriate level of equity to use these solutions, right? We know that with a mortgage, those first most of those first years, you're only paying interest. The principal itself isn't going down. Obviously, that switches at some point, and then that's towards the end is when you start paying more of the principal, and that's when you start building more of the equity. Um, just a side note, George, what was your experience with home ownership, and did you ever consider using your home's equity to your advantage, or have you
Well,
used
so we've been a long time homeowner. We built up a lot of equity,
it?
and
Mhm.
I've been actually thinking about it lately. So stay
Okay.
tuned.
It's all channel conversation.
But well, meaning when I say stay tuned, mean it's just something that I've been actively thinking about
Yeah,
for some things that we want to do, major
absolutely.
things that we want to do, and so I've been thinking about it. So yeah,
Absolutely.
so we haven't done it yet, but we've been thinking about
Absolutely. And as always, these types of financial decisions require due diligence and really earnest planning. So if you are thinking of taking a step like this, then make sure that your financial plan is in order for today and for the next 5, 10, 15, and 20 plus years. Give your friendly neighborhood advisor a call at 315-748-5540. Again, that's 315-748-5540. Or just send me a quick note at michael.jennings@brackensfsn.com.
it. All right, Mike Jennings is a wealth advisor with Brackens Financial Solutions Network LLC and the registered representative of LPL Financial, member SIPC. He is your friendly neighborhood advisor.